Looks like we have critical mass. Hello and welcome, everyone. It's my pleasure to introduce today's conversation. My name is Laura Burks. I'm the Managing Director of Nature and Climate with BSR. And it's great to be here today for the 17th episode of our conversation series, ESG Influencers Leading Transformational Change. And we're really honored to have another stellar guest, Jonah Goldman, the Head of External Affairs and Impact with Generate. So today's discussion will be focused on accelerating sustainable infrastructure finance and development. And by way of background, Jonah oversees Generate's communications, government engagement, and impact assessment strategy. And Generate is a finance company that builds, owns, and operates sustainable infrastructure to deliver affordable and reliable resource solutions. And previously, Jonah led Breakthrough Energy, a network founded by Bill Gates and linked by a common commitment to scale technologies necessary to achieve a path to net zero emissions by 2050. And during that time, Jonah served as Mr. Gates' senior advisor for policy and government relations. And prior to Breakthrough Energy, Jonah, a distinguished career here for nearly 15 years in Washington, D.C., leading integrated advocacy, communications, grassroots campaigns, and led policy efforts on such issues as civil rights, education reform, and nuclear nonproliferation. And Suze McCormick, our co-chair of the ESG Sustainability, Social Enterprise, and Impact Practice with MoFo, will be interviewing Jonah in today's episode. So welcome, everyone. And Suze and Jonah, I'll hand this off to both of you.
Well, thanks so much. And it's a pleasure for those joining and for those who of you who are not familiar with the series. We are very pleased to partner with BSR. Responsibility has been around for about 40 years and has been for that entire period the gold standard in terms of working with companies and investors who are focused on long-term sustainability and elements of ESG, environmental, social, and governance. And so this series was really an attempt to work with BSR and to elevate the conversation sort of above the muck in terms of the political and a lot of the push that people read in the press, because in fact many companies, most investors are still focused for very good reason. We got a little bit of a background, but I would love to hear kind of in your own words. You did go to law school, yeah, at one point, and then you came out and you have been focusing, for the last 25 years on really deep impact, not the greenwashing, but really, working with capital to ensure their outcomes. Tell us a little bit about how you got here.
Yeah. Well, I mean, it was in the pre-call we were talking about Montana and how roads to the west tend to not be terribly straight and they're windy and exciting. And I think that I now live in Seattle and my road here certainly was windy and exciting. I can't say that it was at all a plan. Impact was always a critical piece of my life. I grew up raised by my mom, who was an activist and an advocate for her whole life, and continues to be an activist and an advocate well into her 80s. And it was just sort of assumed that I would go into the family business. And I went to Washington right out of college, and I was a social justice lobbyist for a couple of years before law school, and just kind of got the bug from a political perspective. And then went back and was really focused on civil rights for the early part of my career. It was why I went to law school. It was what I really wanted to do. And after that, and a bunch of advising on campaigns and various different policy initiatives across a spectrum of different issues, I was recruited to come out to the Gates Foundation, and I did similar stuff, policy. I did some communications work. I did a bunch of sort of other things around on a more global level. And that was probably, I don't know, it was about 12 years ago now, but it was definitely the time where I realized I was never really going to be a lawyer. I think I probably held on to that for a while, especially because I worked for legal organizations for a long time and thought I could always go back and be a lawyer. But then I realized that that wasn't going to happen. And then about a couple of years into my time at the foundation, actually quite early in my time at the foundation, I had this just like random set of circumstances that allowed me to work very closely with Bill. And I started doing a lot of advising for him on things other than just the foundation issues related to politics and policy and government relations and things like that. And then also was involved with the program related investments portfolio at the foundation. And he asked me then, because of the fact that I was expanding beyond these foundation issues, to come and work at his private office, at his personal office, so we could do more on some issues that he was very interested in, but weren't the core issues of the foundation. And he was and is quite maniacal about saying like the foundation needs to be focused on the goals that it needs to focus on. So he didn't want people at the foundation focused on other things. And so I went over to his personal office and kind of as an afterthought, he's like, oh, and by the way, I've been investing in clean energy technologies for 10 years. We should figure out something to do with that. And that was in 2014, leading up to the COP, obviously the Paris COP. And one of his biggest frustrations was that the world was going to come together for the first time to really, hopefully, not have the same issue that it did in Copenhagen just a few years earlier, and really come to an agreement around climate. And we were basically only talking about two and a half technologies at that time. We were talking about wind and solar and to some extent EVs. But there was 80% of the economy that was not covered by those technologies. And the world had just basically given up on innovation when it came to the harder to decarbonize areas, and not even harder to decarbonize, like anything other than those three technologies. And so there just was not government resources going in to innovation on things like cement and steel, or on on some of the ag related pieces that were deeply important from a decarbonization perspective. And at the same time, there wasn't really a startup infrastructure because Clean Tech 1.0 was starting, the bottom was starting to fall out or had fallen out at that point.
Mhm.
And so we sort of came up with, through a series of kind of strange events, the idea of breakthrough energy, of basically organizing a number of his um, uh, peers and colleagues to commit to investing in what came out of largely government research labs. That was the original thesis of the effort. And from there, we built that to a series of funds, and realizing that none of these technologies were going to succeed without a policy environment that was going to cause them to succeed. And so we wanted to not only raise the private capital to be interested in accelerating these innovations and helping to get them into effective companies, but we also wanted to make sure that there were the policy environments to pull them out of the lab and put them into a startup environment and get them into building and doing the things that they needed to do to mature. And so we built a whole bunch of different programs of different types of investment vehicles. We had, there were traditional venture funds and those sorts of things. And then in about 2022, I started, well, 2021, 2022, I personally started getting obsessed with steel in the ground. I was like, that's the only thing that really matters. At the end of the day, we can have all of these brilliant, rainbows and unicorns of venture and like early stage technology. But if you can't put a shovel in the ground and then a beam of steel, we're not going to decarbonize anything. And I sort of was looking around I'd been with Bill for over 10 years at that point, and like was looking for my next step. And I knew I wanted to continue this commitment that I had sort of inadvertently made 10 years earlier with Breakthrough. And honestly, I found Generate through a friend of both of ours, who's through Richard Kaufman, who's the chair of our board. And he asked me to go talk to Scott Jacobs, the CEO of Generate. And that conversation just went real well. And I wasn't looking for a job, but I was really impressed with the creativity that Generate took to solving what I thought was the most important problem, which is putting steel in the ground and convincing traditional capital that this was a safe space to invest and a safe thing to build. And I still think that is the number one thing we need to figure out how to do right now. That was a long answer to a very short question, Sue. So hopefully that's what you're.
But it was good because your career sort of tracks the kind of trajectory. I mean, we did have some investment in the 70s, But then really there's been an acceleration, I would say 15, but really the last 12 years in terms
Mhm.
of sustainable infra. And your career has kind of tracked that. And
Yeah.
you notice I sort of started this sort of after Clean Tech 1.0. My view of Clean Tech 1.0 was really a search more for technology solutions and attempts in terms of the scale and the projects were, and the infrastructure was more muted. And so sort of when there was a recovery from that, then some players, including Generate, started around then, started investing heavily. So let's start by looking backwards. And given how close you've been in this space, what are the areas or where has the market worked well? Where there are some areas in terms of decarbonizing where there has been investment in sustainable infra and there is now price parity and there is now really good investment opportunities, but also opportunities to actually reduce carbon. So let's start. What has worked over the last 12 or so years?
Yeah, I mean, it's hard to say something worked because even when you talk, I mean, obviously solar is like the example that everybody relies on. And it's a great example, right? Like we are building out an infrastructure. We're building it out because of this problem. We're figuring out how to build policy structures to allow it to flourish. It's not a natural technology to replace the technology we want to replace. It doesn't have the same attributes as coal does or natural gas does. It's in the sense that it's intermittent, and that's not what our electricity system was built for. But we've largely figured that out to the extent that we're using it right now. The problem with saying that that's a success story is it took 60 years to get to that point. We like and that I think was part of what we were trying to point out, or definitely was something we were trying to point out at Breakthrough, which was like we think of solar as this like quick hockey stick. And it really wasn't. I mean, NASA was putting solar on basically all of the equipment that it put into space in the 50s. And we still weren't able to commercialize that for a long period of time. Wind is probably a quicker thing, although again, that's a technology that was around generating electrons for 100 years. So it's not like that was something that was terribly innovative either. The EV story, I was having this conversation relatively recently where it's people are looking at it as like a drop off of what ambition looked like a couple of years ago. But what you are finding in the EV market is a real tension that demonstrates the success of the product. The fact that like the entirety of the market is responding to this thing. Yes, it's still too small a share of the market, but it's big enough that like the market has to figure out how to do this thing. And that I think is what we're trying to look for. And there was, that was actually a pretty responsible set of policy drivers, commitments from private sector that opened investment pathways to lead to an outcome that's, pretty productive. I think we still are, we're still struggling with the core attributes of what we're trying to do, which is that we're trying to replace the most efficient markets on the planet for some of the cheapest things that we use every day with a different way to create those things that the difference is not addressing the core attributes. And that's just like we've never done that before. We've always had a singular focus on these kind of technology replacements, which is that they either perform better or they're cheaper or some combination of both. These things are often perform worse and are more expensive, but we need them because of this other issue. And we can call it an externality, we can call it whatever we want to call it. And in some ways, we are internalizing some of the externalities through various different mechanisms, through either policy mechanisms or voluntary mechanisms. Like there's all these different tools, but we've still not figured out how to do this. Like, and that sounds pessimistic, but it's really not. It's actually deeply optimistic. We're at the point now where we have to figure it out, and we have the things to figure it out about. 5 years ago, we didn't have those things. 5 years ago, there was no way for us to say we want a clean cement or we want a clean steel and we want to commercialize it. Now we can actually say that. We know the two or three products in those things that have the best chance of succeeding, and now we just need to figure out how to make it happen. That is in some ways a better place, oh, in every way. That's a better place
better
than
place.
having
Yeah.
to invent it and then figure out how to build it. So I'm optimistic in that sense, but we haven't yet figured it out. And the foundational thing we haven't figured out is how capital can effectively flow to scale these types of technologies and
Well,
projects.
that was going to be my next question, and I would put in your list. You've got steel, you've got cement, you've got sustainable airline fuel, you've got water and water infrastructure. You've got a lot. You've got storage, and now, as you said, the biggest advancements. Well, economically, the biggest advancements, took, as you said, more than a heartbeat. Have taken a long time, but there is now you've got renewable that has price parity. It's not worse other than the intermittency, and it's not more expensive. So there has been some success there. But where are the biggest gaps? Is the biggest gap capital? Is where, in terms of getting to the next stage of decarbonization, presuming that's where we're headed, where are the biggest gaps? And then I'll
Yeah,
follow up, and what's causing those gaps, and then we'll follow the next. We'll move to kind of, okay, what do we do about the capital? But go
yeah,
ahead.
yeah. So, I mean, listen, the biggest gap is a capital gap. That doesn't mean it's the only big gap. It just happens to be the biggest gap. So there's other gaps as well. There is definitely capital-oriented gaps there, but there is also like knowledge-oriented gaps. And in some respect, I think that the sort of the world that I used to be in the venture world, I don't want to say it's responsible for them because it was the only one available to like pick up the pieces, create the innovation, and get us to where we are now. It's really remarkable how that capital was organized, how much of it was not just with Breakthrough, but with many of the fellow travelers. It's really incredible how much venture capital has gone into this, even understanding that 1.0 was a failure and everyone going into it knew it was going to be hard. And that's really not the DNA of venture capital to do the hard things that have really well, they do very, very hard things. It's just not necessarily hard things that don't have very clear commercial paths. And this did. The drawback of that is that basically, and this is where there's a major knowledge gap, is that you have technical founders who are largely coming out of PhD programs, who are brilliant scientists, coming up with ways to do crazy things like reinvent how we make cement or steel or things like that. And those are truly like unbelievable things that they're doing. The chemistry is amazing, the physics is amazing, like the things that the science is really, really remarkable. And we've manufactured miracles in this sense. And they were backed by venture capital, and venture capital is not a building mechanism. It's not a capital building mechanism. It's in fact quite the opposite. It's designed to have as capital light types of endeavors as possible, but none of these things are capital light endeavors. These are all asset heavy, project oriented things. If they're not, then we have a problem. And so you have these technical founders with the guidance of venture capital that's saying our way of doing things is to have the most capital light structures as possible. So you may have this brilliant chemistry, but let's figure out how to make that a licensing model. And that works great in software when nobody has to build anything. But if you're a technical founder backed by venture capital and you have some battery chemistry that you're going to try to license, somebody has to build a battery factory. And that's where the capital comes in. And that's the part that the structure as it's oriented now with venture capital, they have not developed that kind of talent within these companies. That's not universal. There are some that are doing quite well, but there's a lot of them that don't know how to build anything. And so then they go and they build their pilot project and they're like, oh, we got that. We can do that. But then they need to 100x their pilot project to get to their first of a kind commercial. And they have no idea how to do that. And they don't have the right people who know how to turn the wrenches and get mud on their shoes. And that is really, because they've never been asked to do that. Neither of those areas have ever been asked to do that. Neither scientific co-founders or venture capital
Or the investors, the early stage
or the
investors.
investors. And so you have these companies coming to a point where they are at a major capital need. And these are very strange capital needs because you have venture capital companies that are used to, again, being asset light, having to build big, expensive things that are not financeable. And so then you have them taking on rounds that inflate their valuation significantly so they can build these things. And those are still kind of like piloty kind of projects.
Mm-hmm.
They're not. So at some point, even if they raise a successful growth round, they have to get to a point where these things can be project financed. And that capability is something that's elusive. Um, and it's elusive because they don't have the knowledge, but it's also elusive because the capital isn't comfortable doing that stuff. And there aren't the structures to make capital terribly comfortable to do that stuff. And that I think is that's the fundamental challenge we need to overcome in the next couple of years.
And is it also, and we'll go back to capital in a second, is it also the system? I mean, you explained earlier, and I think it's a very good way of thinking about it. Like we're we're used to replacing, we're used to like technology driving. So we're replacing something. So we have a whole infrastructure and system developed around replacing A with B that is cheaper and better from a technology perspective. And here we don't have that. And when I was at Climate Week, if you look at some of the high speed rail, the really large projects, that are committed to be net zero, some of the things you hear is, okay, we get it. We could buy green steel or we could buy green cement. The issue is actually also structural, right? In terms of, the contractor can't get insurance because the technology has not been tested at scale. And so, yes, we want to use green cement here, but we can't get a developer that is willing to do it because they can't insure. Is some of it sort of a systemic issue as well as the capital?
Yeah, absolutely. I mean, we're trying to change all of the rules that we had that built the physical economy. We're not trying to change them. Like the good thing is that it's not like orthogonal, but it is a slight change, and those rules are pretty hard to change. And for the last 100 years, we've been really excited that they're hard to change because like some of those issues that you're talking about, Suze, are issues related to safety. Now, it doesn't mean that these things are not safe, but we've judged safety in a particular way, especially with building materials. We've judged safety in a particular way, and that's always worked for us. And so anything that deviates from that doesn't make it less safe. It just makes it not fit into the regulatory structure that we have decided just like says that this thing is safe.
Keeps us safe.
Keeps
And
us
then
safe.
you have the resilience. Then you have, what's happening in Florida and
Yeah.
my home
Oh,
state of North
sure.
Carolina. You've
Sure.
got people are building arguably to code, but weather patterns have changed so significantly. It's like, the risk is there in the building community anyway. And now you want to add more variables in. So I think
Yeah.
in some ways climate may be enhancing the impediments but tell me your views.
Yeah, no, I think that's exactly right. I think that so we have there's a couple of things inherent in that. The first is like there is a public oriented structure that needs to in some ways change. So, well, in a lot of ways change. So that is you've got building codes, you've got safety regulations and various different materials that were built for things that were somewhat different than what we're coming in now. And even just at that baseline, you need to allow certain ingredients to be part of this mix that otherwise weren't allowed to be part of the mix because they were never envisioned. So that's something that needs to come up to date, right? That needs to come up to speed. Then there's a second part, which is we do a pretty poor job of because we constantly think this fallacy that climate change is a future state, but it's not a future state. It's a very much a current state. And for 12,000 years, the climate was relatively stable, and it's no longer stable. And during that 12,000 years, we had that was the time when we modernized being humans, and we made all these rules. But now we have to start thinking of things outside of those traditional bounds. And that really means something. It really means something when it's like the type of cement you're using, the type of steel you're using, the fact that like hail is now bigger than it used to be. And so solar panels are more at risk than they used to be. And you may have to think of different coatings for those things. Like they're really practical problems that you have to solve. And it's not solving them in 20 years, it's solving them today. You
Mhm.
have situations, obviously, like we constantly see in Florida where, whether it's a storm or Miami flooding from underneath, that's the big problem with the geology of Florida, is that it's basically a porous bedrock. So, whereas like New York, you can build a seawall to deal with sea level rise. You can't do any, I mean, you can't do anything in Florida. That's coming up through the bedrock. And we start seeing these things. Insurance companies are the first ones to recognize them. So we have this public thing that we need to update, but we also need to update the way that we deal with insurance companies. And Florida is having a hell of a time with that. And California is having a hell of a time with that, where you have companies who are no longer interested in underwriting any property in some of these
Risk, yeah, the risk is just too high, and the
just
insurance
too high.
companies pull out, and you're going to see in Florida, and our mutual friend Spencer Glendon and others have been predicting for years
Yeah.
that, there's not enough state and federal funding. So on the
Yeah.
state side, there's no longer. And what's the Fed going to do? Are we going to, if you do it for Florida, you're going to have to do it for Alabama and Mississippi and,
Yeah.
California, yeah. So
Yeah. And
anyway.
I would commend Spencer's stuff to anybody who's trying to think about investing in anything infrastructure related, going to probable futures and really doing a little bit of scoping on, if you're ever building a project, what is the likely scenario from a climate perspective. And it's pretty dramatic. It's very different than we expect and different than we built these systems based on. And so we have to be thoughtful about that as well. I mean, this is the complexity of this challenge, is that it is the everything. Like when we were working with Bill Gates to write his book, How to Avoid a Climate Disaster, we were trying to figure out what the most adequate like analogy was to like start it off. And he at that point was like, because he gets very obsessed with authors, and he was getting obsessed with David Foster Wallace, and he had delivered a commencement speech in Ohio, and he used the analogy of the young fish and the old fish, and the old fish saying to the young fish, how's the water? And the young fish saying, what's water? And that was what we decided to start this kind of book with, is that idea that this problem is everywhere. It is the everything of everything, and we need to figure out all these different pieces to it. It's very easy to get into this like deeply pessimistic spiral because it's so challenging. It's also easy to like shift that to an optimistic spiral, which is like, all of these are actually addressable challenges. Like, we can rethink the insurance system. We don't have to rebuild it from scratch. We just have to orient it towards like the realistic likelihood of the next 30 years. We don't have to totally like get building codes out of here. We just need to update them for a series of different types
What's
of
actually
chemistry.
happening.
Yeah.
And that's a really good point. I think, Spencer Glendon, I would also commend to people listening, the work of Bob Litterman, and all of the economic modeling, who, said, I think his National Review article was 12 or 15 years ago at this point, all of our modeling, our economic modeling underlying all of our systems is flawed, because it presumes we're headed for a cliff and we'll gradually apply the brakes, and we're headed straight for the cliff and we can't apply the brakes. So we haven't been willing to yet. And so, we're arguably above 1.5. And so we're going to see more of these. So let's shift back to, what this is, the capital question. So because there is this gap, I think you described it very well earlier. People are looking to government and philanthropic capital to fill that gap. And I would really love your views on kind of when is it needed, and kind of when do you distinguish between government and philanthropic capital? When can it be used to plug this gap?
Yeah. It's in some ways, well, I was going to say it's the big question. They're all the big questions. And I realized that like if I said it was the big question, I would go back on what I said earlier. They're all big questions. The the ability for us to optimize capital to where it's most appropriate is the difference between us doing this quickly and doing it in a haphazard way that leads to, bad outcomes or worse outcomes. We're already in the world of bad outcomes. So in my mind, I think it's really important for us to make sure that different types of capital are used for exactly what they should be used for. There is not enough philanthropic capital on the planet to play a meaningful role in filling the what we called when we were writing the book green premium gap, because we're talking trillions of dollars, and it's just not realistic for us to rely on philanthropic capital. So then where is philanthropic capital useful? Well, all of the things that we need to do require different market dynamics than we have right now. They require different types of policy drivers. They require temporary fixes to allow things to come down a cost curve. And in all of these places, philanthropic capital can play a really powerful and a really meaningful. Then there's impact-oriented investment capital. That's capital that's able to take, I mean, you know this obviously, Suze, but just like for the group, like in fact, I think that you probably taught me this, but that's capital that's able to take an impact orientation, expects a return, but is able to take bigger risks.
Mm-hmm.
There's possibly more of that in the world. That is super valuable money that can go to de-risking hard projects. And I think that that's what really needs to happen, where, or building capital models that make traditional capital more comfortable with coming into this stuff. So it is first of a kind type of stuff. It is building new portfolio construction that's oriented more towards impact and that has some ability to prove the value of various different types of projects. Then I think of government capital, government concessionary capital. That's actually a huge bucket of money. We think of it as like a new thing. It's not a new thing. It was around when we were trying to build out the fossil infrastructure, and it was valuable to building out that fossil infrastructure. I mean, the fossil infrastructure in the U.S. doesn't get built without the highway system. The highway system was not built by the private sector. We didn't as much as we have an aging grid that is like a deeply troubling piece of this puzzle. We didn't build that grid entirely with private capital. These like public capital has been around for a long time as critical to building this type of infrastructure, and it's critical now too. And I think of public capital as being used in a couple of different ways. One is in the earlier stages, like what we have right now with the infrastructure bill. IRA, of course, is something that is hugely powerful, and I'm sure we'll talk about it. But the infrastructure bill is the thing that created the Office of Clean Energy Demonstration and the ability to actually put real amounts of money into early stage projects in order to basically de-risk them and take them down the cost curve. And that is a completely appropriate use of government money. It works for so many reasons. Not only is it good for the future of the country, it creates jobs, it's valuable in various districts, it's got a lot of positive attributes. It can create industries, like all of those things are perfectly appropriate use of taxpayer dollars. That ultimately is what we're talking about. And then there's the tax code, which is kind of a really stupid backward way for us to make this kind of policy, but we do it all the time and everything. And just so happens that the US has this really weird relationship with its tax structures. And in that respect, like also a good thing. But ultimately, in the long term, government capital is going to have to be used probably to make up the green premiums that will never go away, because some of these will never go away. And so at some point, some payer is going to have to play that role, and a public payer is the most likely to pay that role. And then, of course, there's private capital, and private capital has to be more ambitious than it is now. It has to be more committed to the future of a, green future. It needs to reassess how it allocates risk. It needs to be more understanding of some of the things we were talking about with Spencer, and it needs to like come in a big way to these types um, of assets. But it's all only going to happen if like the right mix of pulls are happening. And that includes like there has to be a customer base that's willing to pay, that is in some ways mandated to pay, because there's some policies, and that's only really policy that's going to do this. Is like policy is the only one that can have, first of all, it can be hugely valuable with like green purchase programs or green building codes or any of these things that can juice the market a little bit and ultimately make it the dominant market in a particular area. But at some point, like that is what policy has done. We have seatbelts in cars, not because that's a thing that wasn't cheaper and wasn't necessarily better for the car. But we have them in cars now, and we force somebody to pay for it. We don't have lead pipes. We have these things where we've actually taken a public good and put it into a policy framework and demanded that the private sector comply. And we don't like to say that, but we actually do it all the time, and our lives are better because of it. Like, we're safer, we live longer, we do like all of those things because of it. This is another one of those cases where we're going to have to put all those pieces together.
I agree. And I'm just going to go back on a couple points and provide a little more color. So, philanthropic capital is actually less than 1/4% of the capital markets currently. So, just reiterating your point that there's just not enough. Where it can be extremely valuable is where we've seen it, like the RMIs and the primes of the world, and the incubators. And this is what you pointed to at the beginning. This is where the technology advancement. Let's figure out what is the best form of green cement. Let's figure out what is the best energy storage solution. That can be philanthropic. The other place I've seen it playing a really valuable role is where asset managers are aggregating capital and they want to take on a higher risk. And you can have sort of a first loss slug of people saying, okay, we'll help de-risk this because you are so mission oriented. That allows for that, sort of as an accelerant. The modeling work Treasury has done says it's about 7-1. So if you can get, and some of it depends on the underlying risk, obviously, of the investment. But if you can get, the first loss, you can kind of get 7 times the private return-based capital. Third, you're exactly right. There's more capital that says, okay, we'll take a little less return, or we're going to invest in recycle, which allows it to go further. And then on the government side, that what is one of the most effective solutions I've seen is the work of actually H2 Global in Europe that has taken large slugs of government capital and is focused on the hard to decarbonize by actually creating a market, by creating an entity that's not only pays the green premium, but also buys and then sells, because it creates the market, which is something else that is missing. So just a few thoughts to follow up there. I do want to turn, because you mentioned it, and we hear a lot about it. Talk to us about the Biden administration. You've been tracking really carefully, and really the 3 pieces of legislation that were focused on infrastructure and really a decarbonization in America. And give us sort of just a brief overview. Most people know what they are, but then how successful have they been? And then I'm going to get to the next question, which is, and what's going to happen in the next election to that. But go ahead.
Yeah, I mean, so there's really 2. The third one is the CHIPS Act that did have some pieces that were relevant for this, but most of the heavy lifting was done by by a bill that changed its name in the middle from the Bipartisan Infrastructure Act to the Infrastructure IIJA and Jobs Act, something. I don't remember what the second I was. Infrastructure Investment and Jobs Act. And then the IRA, of course, the Inflation Reduction Act, were the 2 big pieces from a climate perspective. And the answer to how much of an impact have they had is, since that happened, I think Q3 of 2023 was when the lines crossed and renewable investment outpaced oil and gas investment. And I don't think you get to that state without those 2 pieces of legislation. So I think that there's almost no, well, no, not almost no. There is no way to say that those things weren't hugely, hugely valuable in convincing markets that this effort was too big to fail. People have heard now the breakdown of where those dollars are. They're more in red states and red districts than they are in blue states. Truth is that they're pretty well distributed across the country. They've created tons of jobs. There were definitely decisions made in that policymaking that were that led to the creation of industries, or seem to be leading to the creation of industries that are really more about global competitiveness than they are about climate. I mean, if you're just looking at climate, there's no reason to build a battery supply chain in the U.S. or a solar supply chain in the U.S. I mean, even if you just don't want China to do it, there's other places that are probably better suited for that. But that was a policy decision that we made in there, and we're spending lots of money on that. So I think that
The understanding after the supply chain with COVID that we actually needed to have some sort of manufacturing base
well,
and jobs
yeah,
here
and
in terms
jobs. I
of
mean, listen, the J in IIJA is jobs. It was the Inflation Reduction Act, even though to that extent the opposition to the bill was right that it really doesn't have anything to do with inflation. But those are the issues that of course people vote on, and those are super important issues. And I'm not making a value judgment on whether that was good or bad. I'm saying that if you're focused on climate, it was something that like those dollars could have been higher value someplace else, including industrial decarb, which kind of didn't get, other than the huge amounts of hydrogen incentive, didn't get as much of an incentive through those bills. If there's a Harris administration, then I think that you have a very productive opportunity to go back into. There's no Next year there will be tax-mageddon. Like there has to be, no matter who wins, the tax code is going to be opened up. It will be a big fight, and we'll see what happens based on what happens with the election. I think anybody predicting what's going to happen is like, is fooling you, because absolutely nobody knows. Because what happens with the tax bill in 2025 and beyond is about, who wins a particular district in a particular place in the House, because it's going to be that close. But it will be opened up. And if you have a Harris administration driving the conversation, then I think there's a lot of opportunities to perfect what was not exactly optimized in the IRA. I think that you're going to see a much broader set of technologies being incentivized, and I think you're going to see more confidence in a more kind of in a more ambitious set of projects that will emerge from this next go at the tax code. Um, yeah,
understood.
yeah. Obviously, a Trump administration is gonna look disfavorably on that future. Um, the rumors of the death of the IRA are overblown. I think that we already know what the agenda is going to look like. Traditional incentives for wind and solar are probably not going away. The hydrogen incentives are probably not going away. They've got a base in the fossil fuel industry that's making a lot of that money. You'll actually probably have a widening of types of technologies that can feed into the $3 kilogram incentive, which in some ways might actually be best. Which I know is somewhat, people disagree with that, but I think it's probably better for us to build a hydrogen economy and then try to green it than to build a green hydrogen economy, because I think that's much harder. We don't have a hydrogen economy right now. So I think that there'll be a lot of, if we think the past is prologue, there'll be a lot of state and local action that will lead to some pretty creative things happening even during a Trump administration. And so, I do think, going back to what we were saying before, like I do think that this transition is just too big to fail right now. Like we just have too many people with too much capital committed to this, that I don't think it goes away. But the dynamics of what this looks like is very, very different based on the outcome.
And the federal capital, my understanding, has been deployed red and blue states. Again, one of the reasons why, a lot of it will survive. I think the sort of any political vicissitudes is that, there's too much that is already, invested and started and in the ground, and it is too broadly dispersed to roll back.
Yeah. 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 I mean, I guess stranger things have happened. Who knows at this point? But I think that's the best bet, is that's right.
Well, so if people have
There's a
questions, I've got a couple more for Jonah, but if you have questions, please put them in the Q&A, and I will try to cover them in the last couple minutes. Because one of the things when we were preparing for this, one of my frustrations when I look back to, people were talking about people have been talking about climate for the last 25, 30 years. Really, the last 10 years, there's been a groundswell, particularly on emission reduction. There has not been nearly enough on resilience and particularly adaptation. And you will see that repeatedly. But also emissions keep going up. So like we're not actually
Yeah.
moving in the right direction. And I'm a lawyer. One of the things my next call is going to be focused on, is we have now all this regulation, particularly out of Europe, a lot of it around disclosure, and even in California around disclosure, I'm not convinced any of it is actually going to result in emission reduction. So you said some interesting things about the fact that we may not be looking at this the right way and measuring it the right way. Can you give us your views
Sure.
there?
Yeah, yeah. And I think that this is different between the public markets and the private markets, because I think the private capital markets have ability to take risks that the public capital markets just can't do. And I do struggle with this idea that our climate ambition is judged by a snapshot in time emissions reduction analysis that is not allowing us to put capital where I think it's needed in order to lead to deep decarbonization on a 2050 or 2040 timeline. And if you look at that as the goal, which I think, the decarbonization of the economy on that timeline has to be the goal, then there are certain things that you would do today that might end up leading to less emissions reductions today, but will open up markets for large emissions reductions in the future. And that to me is the most valuable allocation of capital. So to the extent that capital is influenced and incentivized from anything related to a level of either disclosure or reporting, which we know that it is, either it's becoming more important because California and Europe are causing these things to happen through regulatory environments, or because institutional investors are putting sleeves of capital against things that they call climate investment. Like wherever you're looking at it, the more important thing in my mind is a dollar going to open up a market in a way that is more likely to scale it over a 2050 timeline? Then I think that's more important than an immediate snapshot in time emissions reduction. And I'll tell you why. I think that number one, that will lead to a very, very different set of investments. If you're an investor and you have to prove that your investment is going to reduce the most emissions in this next year, you will put your dollar towards the most scaled, largest project you can buy. If you are going to be judged by how much your dollar is opening up a market, you are going to put your dollar towards a higher risk and more impactful set of projects, because that thing is going to either open up a supply chain that wasn't available. It's going to increase the access to capital for these types of projects. It's going to decrease the balance of project cost. It's going to allow for a policy environment in a place that doesn't have it right now for these things to happen. These are measurable things. We're just not measuring them yet as to whether this is a good thing, a good investment or a bad investment. And in my mind, that will significantly change capital flows, which is all I think that really matters, is like, are we allocating capital to the right things today to lead to a 2050 decarbonization timeline? And that's what we need to be able to do. I think regulation needs to move in that way. I think these voluntary commitments need to move in that way. I think we need to start judging investments based on whether or not they're helping the overall effort and not whether or not, right. And that piece of it needs to be part of the puzzle. Things that have huge decarbonization potential today need to be invested in as well. It just can't be the only way we judge it. We have to think of these things as portfolios. There's some things we can decarbonize right now. The time value of carbon is not immaterial. It is important, and we need to be doing that, but we also need to be allocating credit. And I think the private markets are the place that makes sense to do it. Allocating credit to people who are doing things that they otherwise wouldn't do in order to open up markets and build these things at scale.
That's interesting. I agree. And it relates to the sort of the initiatives that I'm carefully monitoring, around balance sheet carbon accounting, and liability management on sort of one side, as we, may or may not evolve from the GHG protocol and scopes 2 and 3, which all relates. And the flow, shifting the flow of capital and the time value, and building that into the investment thesis. So let me ask you just a final question, because I can't let it go without talking about this. One of my theories of change is, governance being this, and corporate form being the scaffolding around flows of capital. And if you change the scaffolding, you can actually change flows of capital and impact. I think you agree with me. But I would love for you just talk to a couple minutes about the sort of the form that you chose. I mean, we talked about the evolution at Gates for
Mhm.
Breakthrough and how that influenced how they were able to deploy capital and then generate capital because they're both different, but they're not using your traditional 2 and 20
Yeah.
fund. And what have those how have those forms impacted their impact on climate?
Absolutely. I mean, listen, on the policy side, this is people make policy kind of thing, right? Like
Yeah.
structures of these organizations are really, really important. And the deals that they have with their investors are really, really important. At Breakthrough, the goal for us was to enable the transition as best we could. That's what our first thing we wanted to do. We wanted to deploy more technologies and have them commercialized more quickly. And so we knew there needed to be a significant amount of capital that was flowing into the early stage, and we knew that there needed to be a policy umbrella that was both organized towards public and private policy in order to drive these things out. The best way that we could do that and actually have the coordination that we needed to, and be deeply committed um, uh, to above board conflicts resolution, above board governance resolution, was to really allow the funds to operate with a different relationship with their investors than a traditional 2 and 20 relationship. And then to have this aligned set of organizations that were C3, C4 organizations, but that were also philanthropic funding arms, but that we were able to have an arm's length relationship, but like we still were um, consistently working together to make sure that our goals were the same and that we saw the landscape the same way. And that was an innovative structure that we were allowed to have because Bill is deeply creative and he obviously has lots of resources to bring other people into it. It's not like it's something that's super replicable. Generate is super replicable. Generate is an innovation in allowing there to be patient and permanence to capital that's still oriented towards a return. And I mean, I'm saying this, of course, to the person, Suze, who you basically helped come up with this theory of how we were going to do this, and it worked dramatically well. And the reason why it worked well is because not focusing on a traditional fund structure allowed us to first of all have the patience with some of our early investing to make sure that we were doing it well, but then also to develop the team and develop this information advantage that we know that we have, which is that we have this weird thing where like we have investors who are investing in companies and projects, but we also have people who, like I said earlier, can turn wrenches and get mud on their shoes. And that allows us to find new value in different type of investment pathways because we have a different group of people who understand these projects at like a level that very few others. The way that the sort of tagline internally, somewhat externally, is that the transition is going to be built asset by asset, and we know assets better than anybody else. But like you couldn't do that in a traditional fund structure. Like you had to be able to have a large enough SG&A to be able to hire the right people to be able to do the hard work to have the results that we've had, which are really wonderful results over the last 10 years. At the same time, you need to be able to manage capital. 90% of private capital is in funds, and so you need to be able to manage that capital. So being able to do both is really what the innovation at Generate is. And more firms need to orient towards that model. Others have, like, we're not the only creative firm out there. We're not the only one who's doing these things. But like what we did was like, what is the problem? The problem is traditional capital isn't flooding into these assets. Do we believe that these assets are productive? Yes, we are like mission oriented. We believe that there is a productive way to invest in clean energy assets. So then how are you organizing most effectively for that purpose and then designing back? And Breakthrough did that, and Generate has done that, and some of our, again, fellow travelers, he's like, there are people who are like deeply, deeply committed to this who've done that. But it has to be purpose oriented. It has to be structured specifically to address this problem. It's much, much harder to take really traditional ways of doing things at this stage. Hopefully, it won't always be this way, but at this stage, and put it together for as productive outcomes as we've been able to find at Generate.
Well, I agree with you. I think also the proof is in the pudding, and what I've been interested in is, I would get, 5 years ago, I would get one phone call, every couple months. What's a permanent capital vehicle? And now I think the asset owner class is like, actually, if we're deploying our capital for returns and for positive impact on climate, you know, why are we, investing in these 2 and 20, which are designed for efficient flow of capital, but not necessarily for climate and infrastructure. And, they're designed to make as much money for the managers as possible in the carried interest structure. So all of that to come. Well, Jonah, we're at the end of our hour. I knew you and I could keep talking for quite a while. Thank you so much.
Thank
Lara,
you.
can we turn it back over to you to close us out? And thanks again, Jonah.
Thank you.
Yes, absolutely. Such a deep and rich conversation. I can tell we could have gone on for the rest of the morning here on the West Coast. So thank you both. Thank you to our listeners. Please be on the lookout for an announcement soon regarding our next episode in mid-November. And yes, Suze, thank you for this great collaboration with BSR, and Jonah, an absolute pleasure to have you here today and to garner so many of your really important insights. So wish everyone well, and thank you for a great discussion.
Thank you so much.